the first step is going to be locate the liquidity. The second step is going to be wait for the liquidity to be swept. The third step is going to be change in state of delivery, followed by confirmation. So you can put this as a fourth step, confirmation, if you want, but for me it's the same step as change in state of delivery. So I'm gonna start explaining the first one straight away. In order to be able to locate the liquidity, you need to know which areas in the chart are having actually liquidity. So liquidity in charts is usually located in these areas. So number one is gonna be swing highs and swing lows. Number two is going to be equal highs and equal lows. Number three is going to be relatively equal highs and lows. Number four is going to be trend line liquidity. Number five is going to be daily, monthly, weekly highs and lows. Can't type today, obviously. And the last one is going to be sessions highs and lows. Now, if you're trading and if you have some experience, I'm sure that you're already familiar with these terms, but I'm gonna explain them anyway. If you're new, it might sound a bit complicated, but believe me, it's very, very simple. So swing highs and swing lows. Basically, swing high and swing low, it's any area in the chart when there is a peak before the trend starts to go in the opposite direction. So for example, I'm gonna draw here. Boom. So whenever you see a peak before the price starts to go in different direction, that's going to be a swing high or swing low. So in this case, this is going to be swing high, this is going to be swing high as well, and this is going to be swing high as well. Now, all of these swing highs are not the same. The most important swing highs and swing lows are the external ones, and obviously this one is the external because it's the top of this range, or the swing low would be somewhere down there, like the bottom of that range. But the reason that I drew all of them is because not all the time that the price is gonna go and sweep that external liquidity. Sometimes the price is gonna sweep internal liquidity and then it's gonna go in the opposite direction. So that's why you need to locate all of the possible swing highs and swing lows that can have a reaction. But you have to also know that the most important one is the swing high and swing low. It's going to be the external one. Now, if we go to equal highs and equal lows, it's pretty self-explanatory. So if you go up and then price makes equal highs and starts to go down, there is going to be liquidity left on top of these equal highs. And then if you go to relatively equal highs and lows, I'm going to do the opposite direction this time. So this is low, boom, the price went up, boom, boom, boom. As you can see, those lows, like in this example, are relatively equal. That's why it's called relatively equal low. Then the trend line liquidity is going to look like this. So if you start having a price that's moving in this kind of pattern, it's going to give you opportunity to pull the line here. And then if you notice that every single time that the price touches the line, it has some kind of a reaction. So this is going to be trend line liquidity. Now for the daily, monthly and weekly highs and lows, I think it's pretty much self-explanatory. So if you go on a chart, let's say here, and then you go on a daily, you're just gonna pick a day and you're gonna mark previous day's high and previous day low. And for example, let's use this one here. As you can see, there was a high here, and then there is a low of this particular day here. You see high and low, and then you can notice that the price swept both high and the low. So you can see that the price is kind of gravitating towards those highs and lows, like because the market knows there is like a liquidity on top, and below that's highs and lows of a daily. Then if you go to the weekly, it's gonna be the same. You can pick any week, for example here, boom, and then here as well. And then if you can notice that before price started to go down, it went up, it took liquidity above the previous week high, and then started going down, took the liquidity below it, and then after that it started going up. So you can see that price gravitates towards these levels, and it's going to be same for the monthly. You just go on a monthly chart and then you mark previous month's high and low. Let's say this one, boom and boom, and you will notice that price likes to react from these levels. Now the last bullet point is going to be sessions highs and low. So if you go on a chart, and you can use this indicator that I'm using, it's called Lux Algo Sessions. If you switch it on, it will show you the sessions, and then you can see that, for example, here, before price started going down, the price went and took this London session high, because this price action happened in London, it was swept, and then the price started going in the opposite direction. You can see here as well, there is a New York session low, the price went down, swept, and then started going up again. So from locating the liquidity, this is it. Now after you are able to locate the liquidity, now the second step is going to be wait for liquidity to be swept. So I'm gonna go to each example and I'm gonna show you how it looks like. I'm just gonna delete these internal highs just for you to look easier. And then let's say price goes up, boom, 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 and then it takes this high here. So as I said, number 2, wait for that liquidity to be swept. So by breaking above that high, that liquidity is swept. Now if we go to this example here, it's pretty much the same. Price goes up, boom, 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 and then sweeps that liquidity from the equal highs. In this example here, price goes down, boom, 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 boom. It sweeps those relatively equal lows. And in this example here, let's say the price was going down, it broke that trend line, and then that's going to be how it's look like when the liquidity is taken from the trend line. And now the third step is going to be change in state of delivery followed by confirmation. So how does change in state of delivery looks in general? So let's say the price was going like this, down, boom, change in state of delivery would look like that the price goes up above the previous high, and then gives some kind of correction and goes up. So this usually it's called change in state of delivery, because the price was going from bearish to bullish, so it changed the way it's delivered, right? So it's go from bullish to from bearish to bullish. So in these examples here, to start with the first one, let's say price was going up and then took that liquidity, and then it did something like this. So you're gonna have change in state of delivery here. Now in this example here, it's gonna be pretty much the same. Price went down, boom, 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 gave you change in state of delivery. here just in the opposite direction, goes up, boom, boom, change in state of delivery. And the last one, it's gonna look like this, boom, 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 change in state of delivery here. Now, when the price is went up, swept at high, gave you change in state of delivery. Now the most important thing is confirmation. For the confirmation, why am I saying that you need confirmation? You cannot just open the trade here as soon as this happens and hope that you're gonna be profitable. You need to wait for confirmation. So in that confirmation stage, there is two scenarios. The first scenario looks like this. So let's say the price was going down, boom, boom, boom. It went up, gave you change in state of delivery, and now you are ready to enter, right? But what price does is goes down, it sweeps that low, and then it goes up again. Why is the market doing this? Because here the price was going up, it swept the high, which means that buyers here are induced. Buyers induced. All the breakout traders that are trading change in state delivery or whatever, they're entering either here or they're entering somewhere here on the correction. And then what price does, it goes down and grabs their stop losses, because all the people that they're open trades here, 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 or here, they put their stop losses below this low here, which means that here buyers are trapped. Now, when the buyers are trapped, now what the market does is induce them, trap them, and now we can go up because everybody's done now. We took all the money, so now we can actually do our move and we can make the real change in state of delivery here. Boom, which I usually mark blue, and then you are ready to open the trade here. Boom. Your stop loss will be here, and then you will target somewhere up there. Usually on this type of moves, when you have buyers induced, buyers trapped, and then you have a move, this move up won't give you much of a correction. So don't think that it's guaranteed that you're gonna wait for this price to go somewhere here, gives you opportunity to enter and go. Sometimes it will just shoot up, so I highly recommend that as soon as we break this level here that you should enter the trade. Why? Because there is no liquidity above that high. The liquidity was taken already, the price went down, the buyers were induced and trapped, so there is no liquidity above here. Price has no reason to go up here, take liquidity, and then go down again. Like, that just doesn't happen. That's scenario number one, which is more complicated scenario. And the scenario number two, it's gonna be more simple one. That's when price goes down, induces sellers, and then gives you change in state of delivery, correction, and goes up. We have to assume that there was some kind of liquidity on this level here. So let's say the price was going down, it came to this level, it had some kind of reaction, but then it broke that level, and then by breaking that level, it induced sellers right here. Sellers were induced. And then price goes in the opposite way, takes their stop losses that were above this high. So let's say sellers are entering here, sell on the breakout. They're trying to put their TP somewhere there, and they're putting their stop loss here. So the price goes up, takes their stop loss, gives you a bit of a correction, and then starts going in the opposite direction. So this is going to be scenario number two. And in this type of scenario, you can enter here, which is the same level where the change of state of delivery happened. You wait for a correction, and you can enter here. You don't have to wait for this level to be taken and then enter here. You can as you want, but like I usually would enter here. That would get you some better risk to reward. You can put your stop loss here. I recommend putting it here because sometimes price would come back and sweep this low here, and then it will go up. So just to be sure that you are safe, I would always put it there. So now when we establish what's confirmation, so this what I explained now was confirmation. Now considering that you have confirmation, now we can go up here and then you can open your positions here. So let's say you had confirmation here, boom, you're opening short, you're putting your stop loss here and then targeting something down. Here is gonna be the same, so sell, boom, boom. So here is gonna be long, boom, boom. And then the last one, in this example here, as you can see, it broke the trend line, went up, changed state delivery. Now again, you can open your trade as soon as we reach that level here. You don't have to wait for this level here. And then your stop loss will be there, and then your TP will be there. Okay, cool. So now when you have these kind of diagrams, I hope that you understand what I'm saying. So now I'm gonna go to the actual chart and show you how it looks like in the real time. Sorry guys, I had to cut the video yesterday because I had to do something. So as I said in the previous part, I'm gonna go over the examples now on the chart. So the first example from this list was swing highs or swing lows. In this example, I'm gonna show you swing lows on a Bitcoin chart. So as you can see, I picked this example because it's very good. If I zoom in here, you're gonna be able to identify that we have few swing lows. So as you can see, this is swing low, this is swing low, this is swing low as well. And when this swing low was taken here, you can see how we had a reaction. Now if I go on a bar replay and I zoom in here, you're gonna be able to see the exactly same thing that I was saying on in those drawings. So basically we swept that liquidity to the downside, as you can see, and then after that we had a change in the state of delivery. Boom. Now we don't enter on the first candle, we went one more candle just to see, because for example this can be just a trap, this can be buyers are induced and then buyers are trapped and then the price can go up. So we wait a few more candles to see what's going to happen. So you can see the next candle is making a swing point here, and then boom, this is the sign for you to enter the trade. As soon as we close above this high here, you're going to be entering long here. I always like to give myself a bit of a room for a stop loss, so I'm going to put a stop loss here. And then in this particular example, you could target like 1 to 2 if you're looking for these kind of targets. But for me, I don't look for risk to reward. I actually try to find something that makes sense on the chart for me to target. It can be 1 to 2 or whatever, but I just have to look for something. It can be even 1 to 7 if my target is somewhere up there. I'm not gonna just close the trade because it's 1 to 2. So as you can see, we have a bunch of equal highs here on the chart. So boom, in this case, I will be targeting that high here. And then if we let the chart play, we get a bit of retracement here. And then finally, we reach the TP. Boom. So this is going to be example for the swing highs. Just to go one more time. So we had a swing low was taken, boom, change in state of delivery, wait for confirmation, enter the trade, stop loss below this low here, and then you target the opposite side of liquidity. The second example is going to be the trade that I took yesterday on Nasdaq. I don't trade Nasdaq that much, to be honest, but yesterday was a good example. So as you can see here, we had a relatively equal lows in this area. And then I was waiting for these relatively equal lows to be swept. Now, when those lows were swept, the first thing that happened is we had a change in the state of delivery here. Boom. But in this particular case, this is a scenario of run from the change in the state of delivery. This was actually only a small price action that was here to induce buyers. So with this thing that happened here, we had buyers being induced right here. Buyers induced. Why are they induced? Because they're seeing this as a change in state of delivery and they're opening their trades here. And then price went down below this low here, which means that the buyers are now taken out from the market, because all the buyers that were putting their long positions here, they were putting their stop losses below this low. So when the price swept that low, we know that now the buyers are trapped. So now the next time when we go up and make this change in state of delivery here, I was opening my long position here. My stop loss was below this wick here, and then I was targeting 50% of this wick here. That was about 1 to 2, a little bit more. And then as you can see, we pushed up, we had a bit of a retracement, we reacted off of this fair value gap here, and then again changes to delivery. This was together with the opening of the New York session, so boom. Very clear example for relatively equal lows. So you could see one more time on the left side, we had relatively equal lows. They were swept. After they were swept, buyers induced, buyers trapped. Now we had a change in state of delivery. Boom, your enter, stop loss here, targeting 1 to 2. Now the next example should be trendline liquidity. For trendline liquidity, I know a Bitcoin example from the other day. By the way, look what happened with Bitcoin. Like, this is crazy, crazy, crazy. I managed to make some money today. I took a long, where was it? I took a long from here and I closed it literally here. It was like 1 to 4. I had no idea what to target because like this looks like it's gonna go forever. But anyway, I'm not used to these market conditions, to be honest. I'm used to choppiness, and all these things looks too good to me to be true. So yeah, if I go on a 5-minute chart here, I will show you the example that I know from the other day. So as you can see, Bitcoin started making trend lines here. Boom, this trend line here was made. After that trend line was made, the price went down, it broke the trend line. After breaking the trend line, it pushed back to the range, gave you a change in the state of delivery, and then gave you a little bit of a correction, and then boom, after that correction, you will be entering your trade somewhere around here, and you put your stop loss either here or here, and then you're gonna be targeting 1 to 2 or whatever. I know that there is some highs on this left side here, so I was targeting 1 to 2, and boom, that was somewhere around there. Boom. So this is trendline liquidity. So now we covered swing lows, swing highs, relatively equal highs and lows, trend line. Equal highs and lows are similar to relatively equal ones. I'm not going to go over that example. For the daily and sessions, I showed you that already in the first part of the video, but I'm just going to go one more time over it. So for the sessions, I'm going to switch on here the indicator, and as you can see, for example here, the New York session, again, it's the same example actually. So we went up, swept that high from London, pushed down. Then when the Asian session opened, swept that low from the New York and then started pushing up. So you can clearly see how those levels of sessions was acting like a magnet for liquidity. And then again, if we go to the daily and all these things, daily, monthly, and weekly, you can see those examples as well. For example, let's say this one here. So you can see here we had a high, here we had a low. So before we had this pushed up, we went down, we swept that previous day's low, and then we started pushing up. And the same goes on for monthly and weekly. And you will see these things for a lot. For example, here as well, we swept that previous day low and pushed. So it's not a coincidence. You can obviously see that market is targeting those levels, like here as well, swept at low, some lows here as well. So market is targeting these areas here because there is a lot of stop losses and limit orders in these areas. So I hope that you gain some knowledge here. All this content is for free, so if you can subscribe or like or whatever, not for my personal gain, it's just so I can help as many people as possible. So yeah, if you have any questions, please leave it in the comments. I'll try to answer, and thank you for watching the video. Have a nice day.